Welcome back to Monkeynomics. In our last lesson we talked about how to create a portfolio based only on stocks, which is very aggressive. In this lesson we're going to talk about how to incorporate bonds into your portfolio in order to lower your volatility. I've already touched on bonds in our previous lesson about asset diversification. If you haven't seen it, check it out now by clicking on the card icon. Bonds are what are known as debt or fixed income instruments. Unlike stocks, bonds don't represent ownership of a company, but a debt that the company or government owes you as the bondholder. Unlike stocks, bonds eventually come to term and are paid off. You can't hold them indefinitely, and while the market value of a bond fluctuates, the actual interest paid by the bond never does, even if you sell it to another investor. Okay, I probably confused you, so let's back up. Bonds are usually issued in $1,000 increments. In essence, the company or government is borrowing $1,000 from you for the term of the bond. When the bond is issued, it has an interest rate attached to it known as a coupon rate. It's called a coupon rate because back in the day, a bond had little punch-out tickets that you had to physically redeem to collect your interest. Anyway, the coupon rate does not change. If the bond pays 10% as its coupon rate and the bond is $1,000, it will pay $100 every 6 months, until the bond matures, at which point the investor will get his last $100 payment along with his original $1,000. Okay, that seems simple enough, right? However, bonds can be bought and sold on the secondary market between investors. The inventory of bonds available is based entirely on what investors are selling. It's basically like eBay. So if you're buying a bond in the secondary market, it can cost more or less than the original value of the bond. The original price, which again is usually $1,000, is known as par value. However, depending on what interest rates are in the market, bonds could be selling at a discount or a premium. Remember that bonds pay a fixed rate of interest for their term. So if current interest rates are low and the bond is paying higher interest rates in the market, then the bond becomes more valuable and is sold at a premium. If the bond is paying less interest in the market, then the bond becomes less valuable and is sold at a discount. If you buy a bond in the secondary market, you will receive interest every 6 months just like the original owner did, and you can sell the bond down the road to another investor at a premium or a discount based on how interest rates change, or just hold on to it until the bond matures. Note that if you bought the bond at a premium and you paid more than $1,000 for it, you will still only get the original $1,000 back at maturity. When looking at bonds in the secondary market, you don't want to focus too much on the coupon rate, because if the bond is selling at a premium or discount, it's not accurate. If you buy a $1,000 bond for $1,500 at a premium, and the coupon rate is 10%, you'll still only get $100, which is less than 7% of what you paid. So instead of focusing on the coupon rate, you need to look at what's known as the yield to maturity rate, which is the actual calculated interest rate you would receive if you bought the bond at its current value. If the bond is selling at a premium, the yield to maturity will be lower than the coupon rate. If the bond is selling at a discount, the yield to maturity will be higher than the coupon rate. I know this all sounds confusing, but in practice, it's not all that difficult to understand once you get what the industry jargon means. So why would you want to buy a bond in the first place? Bonds provide predictable interest, as they are debt instruments. Let's compare this to stocks to help you understand the differences. When you own a stock, the company may pay a dividend if it has a profit that year, and doesn't reinvest it. Those dividends aren't guaranteed though. With bonds, the company will pay interest just like you would pay your mortgage or car note. Even if the company doesn't turn a profit that year and doesn't pay a dividend, they will want to make sure they pay their bonds on time. If they don't pay their bonds on time, it affects their bond rating, which is basically like a credit score for companies and governments. If your bond rating is low, people don't want to lend you money unless you're going to pay them more interest than normal, exactly how a credit score works. Just as a high credit score allows you to get a lower interest rate on loans, a high bond rating allows companies and governments to offer lower rates on their bonds, which saves them money. Generally, if you buy a bond that are considered quote investment grade, you'll be fine. If you buy bonds that are considered high yield or junk bonds, you're playing with fire. These companies may or may not pay you back. However, just because a company isn't considered investment grade doesn't mean they're pieces of crap. Just like some people can fall in hard times but still be good people and try their hardest to turn their lives around, companies can go through the same kind of process. Knowing which companies in the high yield or junk bond category to invest in and which to avoid requires a lot of research and time. I personally recommend just using the services of a mutual fund for that sort of thing, and let the research teams do all that hard work for you. Since I brought up the subject, you can buy shares in mutual funds that invest in bonds rather than buy the bonds directly. The The rate the mutual fund will pay will be the average of all the bonds the fund owns, as opposed to a single bond. So the next question is when to go with a mutual fund or ETF for bonds, and when to go with the bonds directly. That depends on two things, the purpose of the bonds and the current interest rate. When rates are low, bonds suck. Newly issued bonds are going to pay the market rate, and bonds on the secondary market are going to be trading at steep premiums. However, you should buy a bond directly if you can answer yes to both of the following questions. 1. Are you preparing for retirement within the next 5 to 10 years? And 2. Are you going to hold this bond until maturity? Bonds are a lot less volatile than stocks. So as you get closer to retirement, you're going to want to get mostly out of stocks because you do not want a recession to start the day before you retire, and watch your money tank just as you're about to start living off of it. If the market is good, meaning stocks are up and bonds are down, and you're retiring within 5 to 10 years, it's time to get off of the roller coaster of stocks and onto the lazy river of bonds. Also, if you're retiring, you're going to want to get a bond with a high yield to maturity if you're shopping in the secondary market, or a high coupon rate if you're shopping in the primary market, and you're going to want to hold it. The bond will pay predictable interest for the entire term of the bond, and it will provide you peace of mind you're going to want as you enter retirement. You don't want to put everything into a single bond, but you're going to want to put about half of your bond investments in actual bonds and not bond mutual funds or ETFs. If you're preparing for retirement and you have the option, go for newly issued bonds over bonds in the secondary market. Since you're going to just hold them, you don't have to worry about paying a premium because they will always be sold at par in the primary market. There is only one thing you have to be aware of with newly issued bonds, and that is the call date if the bond is callable. If it is, you'll have a month and date listed on the bond as the call date. If a bond is callable, it means that the issuer can cancel the bond and give you your money back at that date if rates are favorable to the issuer. Think of it like refinancing your mortgage when rates go down. Let's say you get a mortgage and your rates are 5%, and suddenly rates drop to 3% and you refinance. When you refinance a loan, you cancel the old loan and start a new one. When a bond is called, it is canceled and a new bond is issued at the lower market rate. Now, unlike a consumer loan, the bonds can only be called during the month and year listed on the bond as a call date. This is their only window. If companies could just call their bonds whenever, nobody would buy them. But the callable feature allows companies to issue long-term bonds and have an escape hatch if rates dramatically change to their favor within the first few years of the bond. Once the call date lapses, if the bond isn't called, that's it. The bond will be in full effect for the remainder of the term, assuming that the bond doesn't have multiple call dates occurring every few years, which is uncommon but not rare, especially with municipal bonds. Since the callable feature is a benefit to the issuer, callable bonds pay higher interest than normal bonds to make up for it. There are also some bonds that have additional features that benefit the investor rather than the issuer, such as convertible bonds. These are bonds that can be converted into stock. Since these bonds provide a benefit to the investor, they pay lower interest as a benefit to the issuer. So now that we're all experts on bonds, why would you want to own a mutual fund or ETF instead of just owning the bond itself? The reason is that bonds mature, and if the bond matures prior to your retirement, it's not really doing much for you. You don't need the money now, so you should be working and living off of your normal income while your stocks grow and make you money. However, you may want to have some portion of your portfolio in bonds, even if you're not close to retirement, if your risk tolerance is lower than aggressive. This will offset some of your stock risks, lower your portfolio's beta, and give you more predictable growth year over year. The cost is you are very likely to have lower overall growth over the long term, but investing is half about the numbers and half about how you feel about the numbers. I would rather you be in a portfolio incorporating bonds that earn 6% instead of 10% and know that you'll be comfortable with it than have you in a portfolio earning 10% but the swings are causing you panic attacks and you end up selling early and losing money. Again, if you're just incorporating bonds to lower your portfolio's risk, I recommend using a bond mutual fund or ETF as opposed to shopping for bonds directly. Let the managers do all the hunting for you and help you avoid having to worry about staying up to date with interest rates, call dates, and all that stuff. If you remember our last lesson, we were using the 10-year average and the beta to fine-tune our portfolios. Incorporating bonds drastically lowers beta because bonds are steady and predictable, and beta is a measure of volatility. On the other hand, bonds will appreciate or depreciate in the opposite direction of stocks. When stocks go up, bonds go down, and when stocks go down, bonds go up. This is because the government raises or lowers the interest rate based on the economy. Generally, when stocks fall, it's because we're in a recession, and the government will lower interest rates in response, which raises the value of bonds. Conversely, when stocks are doing well, it's usually a sign of an improved economy, and the government will usually raise interest rates because if they don't, there's going to be inflation. When the government raises interest rates, the value of bonds goes down. Now currently we're in an interesting period where the government is allowing the rate to remain low to encourage inflation. But when inflation begins to get out of hand, they're going to raise interest rates again. If you're concerned about inflationary risk, the best hedges are stocks and commodities, including precious metals. Essentially, stocks are where you make your money, while bonds hedge your portfolio from stock losses because they move in the opposite direction and pay consistent interest. If you're in one of the lower risk tolerance categories, you're going to want to find that sweet spot, where you're earning enough interest to live off of for the rest of your life, but the portfolio is stable enough for you to enjoy your retirement without having a heart attack when you turn on the news. Remember that the US has a recession about every 10 years or so. Assuming you retire in your 60s and live into your 90s, that's at least 3 recessions your portfolio is going to have to last through while you're living on it. And that's why bonds are very important to your portfolio as you enter retirement, or simply if being too aggressive in stocks isn't for you. So that's it for this lesson, and at this point, I think I've given all the basics and given you the tools to get started. I have had some questions regarding other assets like real estate, so I may do additional videos on specific requested topics in the future, but my primary goal with this series was to give you some basic financial and investment literacy, help you understand the different assets and their functions, and give you some simple tools to design a portfolio and track its progress. Just remember that there are no guarantees in life, especially with investments. I can't promise you that you'll be rich if you listen to me, as out of all the methods to become rich, some amount of luck is required. However, there are countless ways to become poor, and if I've done nothing else, I hope that I've given you some tools that will help you not be poor. One last bit of advice. Money won't make you happy. Money is just a tool. Money allows you to do what you want when you want, but if all you have is money, then all you have is potential, and potential that is never realized is wasted. Some people acquire money and all they gain from it is the fear of losing it. How much money do you really need? My answer is enough to do what you want and live the life you want. Maybe with a little extra for a rainy day. Be in control of your life, function at your highest capacity, and accomplish your dreams. Take care.